If you're a pre-retiree and wondering what tax moves you should make before the end of 2024, then you'll want to watch this video. I'm going to cover 7 tips that can help you reduce your taxes for 2024 before the year is over. Welcome back. This is episode 221. Last week I covered 7 year-end tax moves for retirees to make, and this week I want to cover 7 year-end tax moves for pre-retirees to make. If you didn't watch my video or listen to my podcast last week, then make sure you do. But if you are a pre-retiree, then you want to make sure you pay attention to this episode, as I'm going to cover 7 great tips to help you lower your taxes for this year and even beyond if you choose to continue using them. So tip number 1 is to make sure you're maximizing your contributions into your retirement plans. I sit down with a lot of folks who I see have the opportunity to be contributing more into their 401k, their 403b, their 457 plans, or even if their employer offers a simple plan, but they're not taking advantage of that. Now, most people that are contributing to these plans are doing it on a pre-tax basis. Contributing on a pre-tax basis is what's going to make the most sense for a lot of people, especially if you're a pre-retiree, meaning you're going to be retiring in, let's say, the next 3 to 5 years. Typically for people that are getting close to retiring, you're probably at your maximum earning capacity, or you're making the most amount of money you've ever made in your career. And you're also going to be retiring soon, which for many people in retirement means your income is usually less when you're retired. That means you're probably also going to be paying less taxes when you're retired. So as you get closer to retiring, I'm a believer in more of pre-tax contributions. That means the contributions you're making into these plans is helping reduce your taxes for the years you're making the contributions. The other option is post-tax contributions. And that means a Roth account, so a Roth IRA, a Roth 401k. Those can be fine as well, but those take more time to build up so that you can actually benefit from the taxes that you're paying up front. So you do have the option also of splitting those. You can do some into the pre-tax, some into the Roth as well. But regardless, let me just cover again what those limits are for 2024. So a 401k, a 457, a 403b plan, if you're under 50, allows you to contribute $23,000 for 2024. But if you're over 50, there's an additional $7,500 that you can contribute, up to $30,500. So a change that you could make if you're not on track to contribute the maximum to your retirement plan, the 403b, 457, or 401k, and you have the ability to do that, if this money is just going to wind up coming back to you as a tax return, or it's just going into your savings account, consider bumping up your contributions so that you contribute the maximum, especially if you do it on a pre-tax basis. That's going to lower your income tax for 2024. The other plan, if you have a simple IRA plan, that has a lower contribution of $16,000 if you're under 50, or $19,500 if you're over 50. But either of these options allow you at any point to change your contribution that would be reflected in your payroll deduction. And you still have a number of months until the end of the year where if you're not close to maximizing, or maybe there's been a change in your income, you can make the change to your contribution so you can hit that maximum, or maybe even just contribute a higher amount than you were contributing before. So the second strategy would be if you have even more money to contribute above and beyond those limits, you're trying to really maximize what you can get into your retirement plans before you retire. Maybe you're trying to make up for last time. Then if your retirement plans allows what's known as after-tax contributions above and beyond the 401k limit, then that's called sometimes a mega backdoor Roth IRA. And how this works is that all profit-sharing plans, and that's what a 401k is, profit-sharing 401k plans have a maximum limit above and beyond what we talked about earlier. The maximum limit is actually $69,000 total contributions into the plan between what you put in and your employer for the year for 2024. Or if you're over 50, it allows the total contribution to be $76,500. So what does that mean? That means that if you're, let's say, over 50, you're going to put the $30,500 into the plan, but you wanted to put even more, up to that additional $76,500, then there's an additional $46,000 you could contribute into this plan. Now, I know that's a lot of money, but it doesn't mean you have to contribute the maximum. Maybe you had the ability to save an additional $10,000 for 2024, or maybe even into future years. Then you could put this money into the plan as an after-tax contribution. Now, how that helps you is converting that money over to a Roth IRA or Roth 401k, because that additional $10,000, let's just say in my example, can be moved over to the Roth side, where then now you've got an additional $10,000 in your Roth bucket of money, and that could also be converted, or I should say, when it's over into the Roth, you don't have to pay tax on any growth on that money. So the other option would be that you just save that $10,000 into investments, stock funds, let's say. Well, every year, if those stock funds are paying dividends, they're paying capital gains, you're having to pay tax on those. Also, if you go to sell them, if you've had a capital gain, you're going to have to pay tax on that as well. But none of that exists with the Roth IRA or Roth 401k. That's one of the benefits of it. You don't pay tax on dividends, you don't pay tax on capital gains, and you don't pay tax when you withdraw money from the account. So that's why it's so powerful to get money over to the Roth. Now, a lot of people that are considering making a contribution to the Roth are fortunate that their income is above what the Roth contribution limits are. The Roth contribution limits for a single individual or a married couple filing jointly. So this is a way around that if your plan allows for after-tax contributions. So theoretically, you could be putting $69,000, $76,000, $500 if you're over 50, total contribution between what you put in and your employer on an annual basis. So if your employer has a match on what you put into the plan, then you'd have to back that out to determine what the total contribution is that you could put into the plan. So the first step would be to check with your employer, see if they allow after-tax contributions. If they do, then, and if you had the ability to save more money for retirement, then consider putting even more in above and beyond the 401k limit. So you'd want to first be hitting the 401k limit for yourself. I'll just use 401k instead of 403b or 457. And then you can decide to contribute more above and beyond that. Now, to really take advantage of this, you have to have the ability to follow tip number 3, and that would be doing a Roth conversion of this money in your plan. Now, you always have the ability, if you have any pre-tax money in a 401k or IRA, to convert that over to a Roth account. I've talked about that before. You'd be paying tax on the income for that year. So if you're converting $50,000, you pay tax on the $50,000 based on your total income for the year, and now it's moved over to a Roth. That's obviously available to everyone. But this move, the ability to do what's known as an in-plan Roth conversion, is not available. So if you check with your employer, they allow after-tax contributions into your 401k, and they also allow what's known as an in-plan conversion. What that would mean is this after-tax money that you're contributing, or in our example, let's say it's $10,000, that would be moved over from the pre-tax account over into the Roth account. Why would you want to do that? Because any gains you have on that $10,000, if it's not moved over to the Roth side, is going to go into your pre-tax account, meaning you're going to have to pay tax on that additional gains when you take the money out in the future. But if you can make the after-tax contribution into your plan, and then you're immediately able to convert it over to the Roth account in your plan, then that helps you to get the maximum growth on this money in an after-tax fashion. So ideally, your plan allows after-tax contributions. They also offer a Roth 401k option, and they allow in-plan conversions. Now, this is getting a little complicated, but it can all be answered by your 401k provider or your HR department. Then you'd have the money go immediately over to the Roth 401k, and any growth you have on that money will be in the Roth account, so therefore it will be tax-free. Your plan also could offer the ability to do an in-service distribution if they don't offer in-plan Roth conversions or they don't offer Roth 401k. Well, what does that mean? Well, this after-tax money that you have in the plan, if they allowed for an in-service distribution, that means you're still in service to the company. You're still working there. That money could get moved out of that plan over to a Roth IRA that you open up somewhere else. So that accomplishes the same thing of getting that money that you contribute post-tax over into the Roth IRA. The only problem is there's an additional step because you have to have a distribution made and the check has to be sent to you or sent to your company, your custodian that's holding your Roth IRA. It's still a good option. The in-plan Roth conversion would be the best option to the Roth 401k, but the second best option would be the in-service distribution. The third best option would be that if your plan does allow post-tax contributions, but doesn't allow either an in-plan conversion or an in-service distribution, you have to wait until you're separated from the company to take that post-tax money, that after-tax money, and then deposit it into a Roth IRA. This option is certainly not as good because if you do this, let's say you contribute $10,000 or even more into your account on an after-tax basis for a number of years, maybe your total contributions were $100,000, and you had to wait until you retired to move that money, any growth on that $100,000 did not grow tax-free. It actually went back into the after-tax portion of your retirement plan. So only that those contributions get to move over into your Roth IRA, not all the growth on that. So that's why that's the least beneficial option. It's still a good option, but the main option you really want would be in-plan conversions and secondary in-plan distributions. But it is a way that if you're looking to really max out what you can put into your retirement plans, then you'd put the most into the 401k on a pre-tax basis. Then you would put the after-tax money and convert it to the Roth as soon as possible. So that would be the third tip on how to reduce your taxes and get that money over into the tax-free side. That after-tax money isn't actually reducing your taxes, but the ability to get that over to the Roth account is going to help you reduce the tax you're paying on the growth or the income from that money rather than just putting it into a taxable brokerage account. So tip number 3 would be to make charitable contributions. This is a way that you can potentially reduce your taxes. If you're somebody who's already making charitable contributions, there's a couple ways that you can do it in one way that could possibly benefit you the most. So depending upon how your taxes are filed, due to the Tax Cut and Jobs Act of 2017, I've talked about it many times, or sometimes known as the Trump tax cuts, many people are not able to itemize their taxes due to the limitation of $10,000 on state and local tax. So that means if you make a charitable contribution, let's say you donate $3,000 every year to your church, you're not actually able to write off that $3,000 donation because you can't itemize. But what if instead, assuming you can't itemize, you made that contribution first to what's known as a donor advised fund? I've talked about it before in past episodes. This is a fund that you set up usually at an investment company. Like Fidelity has one, Vanguard has one, a number of other companies do. And it goes into a fund where you choose how it's invested. And then at any point, you take that money and you send it out to a 501c3 charity. But how this could benefit you is not so much in making just that contribution. It would be that if you donate a sizable amount that allowed you to potentially itemize your taxes. So if you made a sizable donation, that might be enough itemized deductions that would allow you to itemize your taxes rather than take the standard deduction and could save you more. So if you had the ability to maybe make 3 or 4 years of charitable contributions into the donor advised fund, that could allow you then to maybe itemize your taxes, save more in taxes, and then over time, you decide to send that money out to the different charities that you contribute to. So that's tip number 4 as far as how you can potentially make a charitable contribution and also get a tax benefit from it if you're currently not able to itemize your taxes. If you're already able to itemize your taxes, then you can keep doing what you're doing, but if you're one of those individuals who can no longer itemize, it could be because you live in a state with high income tax and property tax, or maybe you've paid off your mortgage and you no longer have that ability to deduct mortgage interest. These are all reasons why people are no longer able to itemize taxes. Then a donor advised fund contribution could be a way to do that for at least a year or two. Tip number 5 would be to consider exercising your non-qualified stock options this year. So non-qualified stock options are taxed as ordinary income. And if you find yourself in a year where you have lower income, it could be beneficial to think about itemizing, or I should say exercising, these stock options. You could also wait until future years. Maybe future years your income is lower, but if you have looked at your income this year before the end of the year and it seems lower than it will be in future years, then maybe exercising these options could be beneficial because you could pay lower tax on them. Just exercising them is not going to lower your tax. It's more looking at what your projected income is for the year and making a determination of when is the best time to exercise them. It could be down the road, maybe after you retire, when your income's lower, but it also could be now if you find yourself having a lower income year than you've had in the past. So tip number 6 is not necessarily going to help you for this year, but it could help you potentially for next year. And that would be to max out your FSA contributions. So an FSA account is a flexible savings account that is available to people in usually non-high deductible health plans. And there's 3 types that you can make contributions to, and they all allow you to make contributions on a pre-tax basis and then pay for medical related expenses or other expenses, as I'll cover in a second, where you can then deduct that. You're deducting the contribution. So therefore, if you're in, let's say, in a 30% tax bracket, you'd be saving 30% on these expenses rather than just paying for them out of the pocket. So the most common is just a healthcare FSA, which you can put in up to $3,200. And if you and your spouse are covered by plans, you could each have one. And this, again, could save you taxes on medical expenses if you're going to spend $3,200 a year or more every year on out-of-pocket expenses. Then think about making a contribution to this. You also could have a limited purpose FSA, and this allows you to pay for dental and vision expenses only up until your deductible that you've met. So this is another one that you could have in addition to the healthcare FSA, and this also, I believe, is $3,200. And the last is a dependent care FSA. If you're paying for child care that's allowing you to work, then you could contribute $2,500 per person or $5,000 if you're a family, and could allow you to save on child care expenses. Maybe you're paying for daycare for your child. Well, think about maybe putting money into this account because it will give you a tax savings on it. Now, why I said this is not necessarily going to help you this tax year is because usually you can only change these contribution amounts during the open enrollment unless you have a qualifying event, which is a change in marital status, a birth or death of child, or a change in employment. If one of those has occurred this year, then maybe you can make a change before the year is over to change what you're contributing into these plans. And the last thing you can do would be to, the 7th tip would be to max out your HSA contributions. If you're in a high deductible health plan and you qualify for a health savings account, then it's definitely something you want to think of taking advantage of. I've talked about it numerous times in this podcast. And the benefit of this is, again, you're putting money in pre-tax. It's giving you a deduction. If you use it for health-related costs, it comes out tax-free. But most of these accounts allow you to invest the money, and that's where the real benefit comes from. If you can leave the money invested for a number of years, you can then most likely just be spending your gains and let the principal stay in these accounts and continue to earn interest or earn growth on this money. So as a single individual, it's $4,150 for 2024, or as a family, that's just you and one dependent or you and a spouse, the limit is $8,300. And if you or your spouse are over 55, you could also contribute an additional $1,000. So that's another great tip on how to lower your taxes for 2024 and also potentially use this money down the road or invest it and use it even even more into the future. So the big thing about these accounts is that you can change your contribution at any point. So between now and the end of the year, just like the 401k, you could increase your contribution if you're not going to hit the maximum. And that limit, again, is between what you and your employer put in. If you also have until the tax filing deadline of 2024, which is April 15th, I believe, of 2025, to make a contribution up to the limit as well. So think about doing that. Those are 7 tips that can help you lower your taxes for this year and beyond. Maybe one of them is appropriate, maybe all of them, but make sure that you talk to your accountant or your financial advisor about whether or not you should make some of these changes before the year is over, as we do have the 4th quarter coming up. So you have a good amount of time to make those changes, but time goes quick, so take action as soon as you can. So I hope you found this episode helpful. As always, if you have a listener question you want to have considered for a future episode, consider going to retirewithryan.com and clicking on Ask a Question. Have a great week, and I look forward to talking with you next Wednesday. Take care.